India has money, $1 trillion at least in the high net worth and ultra high net worth space, as we discussed before. And as Mr. Sethi said, even more in the corporate treasuries. So, how much of that can be invested in alternative investments, especially venture capital and new age businesses? Mr. Munjal explained that his family office is not just a family office, it's an investment office. And he's put in place the investment processes to do it very methodically. Now, let's hear from a range of other family offices. And to do that, we have an interesting panel. So let me read out the panelists. The first is Amit Ranade. He's the head of investments at Catamaran Investments, having joined there last year. Anshuman Goenka, the head of private equity at IIFL Asset Management. Keshav Reddy, managing partner, Reddy Futures. Nimesh Kampani, co-founder and CEO of Tribeca, which is a Let's Venture initiative. And to moderate them, we have Tejesh Chitlangi, senior partner at IC Universal Legal. The stage is all yours, Tejesh.
Good evening, everyone. Hansi, many thanks for the kind introductions. So we have a fabulous topic for discussion in this panel, wherein we are looking for some key insights from an Indian family office perspective when it comes to investing in new businesses. Now, interestingly, per various market reports, approximately 30% of the estimated USD 100 billion of the capital to be raised by startups by 2025 is going to be contributed by family offices. Now, this clearly suggests that family offices hold a tremendous significance as a new age investor class. Not only they have actively invested directly in Indian businesses, but have been significant LPs in various alternative investment funds you see in the market today. So for a topic like this, I could not have asked for a better diverse set of speakers consisting of leaders from some of the renowned family offices in India, as well as some of the leading funds and platforms channelizing family office money in the Indian enterprises. So I have the private equity champion Anshuman from IFL Capital with me, who has saved significant amount of family office money over past many years. I have Amit with me from Catamaran, needs no introduction, one of India's biggest professionally managed family office, and can expect some key insights on the family office investment themes and some of the key trends from him. I also have the young and dynamic Keshav from reputed Reddy Family Office with us, and looking forward to some real interesting takes from him. And then I have Nimesh in the panel, who has been running innovative structures at Let's Venture and Trika, and has done an impressive matchmaking between the family offices and the startup ecosystem. So without any further ado, let me start first with you only, Nimesh. So as I said at Trika and Let's Venture, you have been bridging the gap between several family offices and new age businesses. Anything noteworthy you would like to share as a key reason for a rapid increase in the number of family offices in India? And also any shift in the investment habits of family offices you have witnessed over a period of time in past couple of years? Over to you, Nimesh.
Thanks, Tejas. So I think I'll straight away deep dive into one of the surveys that we had done very recently, and we released a report on the family offices called the Private Market Monitor, where we surveyed more than 100 family offices and ultra HNIs. And we got very interesting outcomes out of that, right? One of the most important ones was, 83% of the respondents said that they look for nonlinear returns when they're investing in private markets, right? And that is something that really stands out, because the next data point was that when it comes to allocation of asset, right, 18% of their wallet goes into private markets, right? So that would be a mix of venture capital, PE, direct equity participation, and debt funds as well, right? And very interestingly, of this, 47% was in direct equity, right? And that's where a platform like us exists, because we provide that opportunity to family offices. Uh, and if you go to see, I think, how the ecosystem has evolved, and we have Keshav, Amit to add more on that, is that if you just go back few years back in time, primarily family offices and ultra HNIs were very happy being LPs on funds, right? And they would get some co-allocation rights. There was not even a family office structure if you go back 7, 8 years back. But today, I think we've come a long way. The investor community has matured when it comes to the family offices and UHNIs. They want to go beyond just being LPs on funds. So a lot of them are structured, and Amit and Keshav are the best examples here, where they have structured family offices. They're professional fund managers who run it, right? There are proper investment committees to take decisions. And in fact, over the last few months, we started seeing them leading the rounds as well, right? And if I were to just look back on how the allocation is happening, I think uh, the 70% of the respondents said that they have doubled their allocation in private markets in the last 5 years, right? So I think, and to just sum it up, I think I would say the next decade is for private markets. The returns that you will see in private markets will by far outnumber the returns that you would see in the public markets, because we are just at the beginning of the cusp in terms of growth, right? It's just the tip of the iceberg. The 100 unicorns is just the beginning. I think the next decade will belong to India. So with that, I leave it to you to take it forward.
Shanamesh, I think real interesting findings. I think the key to note is the allocations in the private markets have significantly increased. I think that's good news for the entire ecosystem. So thanks for those insights. Anshuman, coming to you, as the head of private equity at IFL Capital, the range of alternative products we have launched in past many years has been really impressive. So how are you seeing family offices as a significant investor class in AIFs increasing over the past few years? So would be glad to have your insights on this.
Thank you. I think the big source of this is the monetization of employee and founder equity across a very large number of businesses. Every year we are funding 1,000, 1,200, 1,500 businesses. Over time, the industry has gotten better. The industry which is attending the IVCA sessions has gotten better at generating, filtering, sieving this out. And you see now across not just new economy unicorns, but also conventional businesses, a significant amount of wealth being generated by founders, and not just founders, the top team, the one downs, etc., etc. This has happened in banks. This is happening in healthcare companies, and certainly happening in consumer internet and enterprise tech companies. Now, where does all this money go? Most people want to sort of take this to some safe preservation mode, which solves for a large part of it, which is the foundation. But over and above that, there is a great appetite for unlisted private equity, because people have already tasted, the private equity process. So they have seen that a private equity manager does a genuine selection job. By and large, the batting averages have improved over time, and they want to participate in the next set of companies, because somebody who has monetized their ESOPs in a bank or in a healthcare company will want to participate in a broader basket of such companies. So that is factor one. The second thing is that you now have seen AIFs being recognized as an asset class, right? I think the industry today is about 6 lakh crores. By contrast, the mutual fund industry, 37, 38 lakh crores, right? So if you see the growth in this market itself is growing at a very, very rapid clip, not just because people are monetizing, as I mentioned in the first point, but because people are moving away from more conventional assets to alternate assets. Or, there's a blend. Alternates are getting more mainstream. And how are they getting more mainstream? By their product design. So to give you an illustration, I have spent most of my career in private equity. Private equity is typically globally a long tenure product. It's a 8+2, 10+2, 12+, sometimes 2 product, right? In India, you have managers, and we're one of them, who have offered a shorter design of product. They say, we'll participate in companies which are 1, 2, 3 years from an IPO. So 5 or a 6-year product. So you're basically getting products designed and tailored to the Indian family office, which is also creating, another source of sort of activity in the space. And finally, there's a product variety, right? So, just to plug my own, toot my own horn, we've got 30 AIFs. 15 in the private equity space alone. The last thing that was talked about was a tech fund. Prior to that, in 2020, we came out with the financial intermediaries fund. We're just right now doing a pre-IPO fund. Of course, we have products in credit, performing credit, real estate, and in the listed side. So there's a basket of products that is available to suit different sort of preferences, different needs and requirements. So I think this is a very lively story. And finally, there is supportive regulation. The regulatory environment is actually pretty benign to this industry. They see that private capital formation in a productive manner will be augured by private capital. You've had the finance minister mention it. You've had the prime minister mention it. So this is one direction of travel which I think has a long runway. So that's my bit.
No, I totally agree with you, Anshuman. The regulations have come a long way because prior to 2012 era, when alternative investment funds were not there, and it used to be a venture capital fund regime and one size fits all formula in which it's a private equity venture capital hedge. Everything was under the same category. With the alternative funds, various categories, subcategories, the tailor-made offerings which the fund managers can do today, and with the kind of sophistication regulations have achieved, be it the disclosures or the track records or the reporting requirements, uh, obviously the regulations have come a long way. And over a period of time, it has become conducive for the fund managers to make good informed offerings. So that's really helping the market. Thank you so much for those insights, Anshuman. Amit, coming to you. Catamaran as a family office has its own alternative investment fund. I can see that you did register an AIF very recently. And that's one trend, at least as lawyers, we have seen of late amongst several family offices, possibly due to the unique regulatory advantages and AIF accords, right? So, what's your take on that? Is my first question. And even otherwise, it seems that Catamaran's preference has always been direct investments and not through the alternative fund managers, due to probably its scale and it can afford professional fund managers and a large team. So, what would be your advice for the other emerging family offices on what different approaches they can follow?
Sure. Thanks, Tejas. Catamaran is one of the large domestic institutional investor. We manage north of $1 billion across asset classes. And our vision has always been we wanted to be a globally respected catalyst backing innovative ideas from passionate and value-based entrepreneurs, and frankly help them build scalable businesses. So that has always been our focus. You're right. I think, as you had mentioned and Nimesh had mentioned, when we started about a decade ago, we were probably one of the very few that you could count on number of fingers, and that has definitely increased over the last few years. As Anshuman mentioned, there's been liquidity in entrepreneurs, and they're redeploying that capital back. Our focus has also been to promote entrepreneurship and ensure that the company and the entrepreneurs do get the requisite capital. So our approach has been, as you correctly said, yes, partner with the entrepreneurs directly and help them and assist them through their growth journey. Regarding advice to some of the emerging family offices, I would definitely say specialization would be one of the key elements. As typically the generic approach would be to have a traditional asset allocation model and looking at allocations across various asset classes. I think ultimately to gain the respect of the fellow entrepreneur and a prospective, building specializations in subsectors, certain verticals is a key in getting the right set of partners. So I would say one of my advice to the emerging family offices, as you had mentioned, would be to build that capability either by hiring the specialized team members and building those operating capabilities. Ultimately, the partners, as you mentioned, we do believe family offices as a provider to capital would be a large portion in the coming years, and ultimately bring capital and connects to the fellow entrepreneur. Coming back to your AIF point, yes, we have an AIF in the market, and frankly, unlike the global markets where large institutions like us get the accredited investor or a global sort of qualified investor tag. Unfortunately, in the Indian context, there is no structure where there could be a equal footing with some of the other institutional investors, and AIF does provide the flexibility. Having said, different sectors, different cuts, and most importantly, gives the larger family offices these institutional capability, which is one of the key elements that why we have opted for an AIF.
No, great, Amit. So at least we have seen as a few of the prominent reasons you get a post-IPO lock-in exemption, right? So if you're not a QIP, you're not an alternative investment fund, you will
Yeah.
get that exemption. There are a lot of exemptions from the significant beneficial owner disclosure
Yep.
norms. You are a
Yep.
QIP and can have
Yeah.
allocated even in the public market. So
Absolutely.
quite a few reasons we have at least seen the family offices really looking forward to set up their own alternative investment fund. So thanks for the insights there. Amit, Keshav, coming to you. At the Reddy Family Office, you invest in high growth companies for a very long term, with a very long term horizon, is what my understanding is. So, how has been the deal flow for the family offices compared to the other private equity and venture capital funds? And have you seen the portfolio entities behaving a little differently with the PE/VC funds compared to the family offices when you're going for the direct investments to them? And has something changed in past few years, because we have seen a lot of young science like you who are now leading their own private family offices. So what's your take on these?
Thanks, Tejas. I think fundamentally how we see PE community has several advantages. Family offices have their own set of advantages. And when I define family offices, it is, like what Anshuman said, it's entrepreneurs or serial entrepreneurs who become angel investors, or second tiers, third tier in consumer internet companies who become very successful angel investors. So I would take the entire gamut going up till Sunil Munjal, who just spoke earlier. What's ending up happening is that most family offices have certain things going for them. One is the risk appetite. Most of them have been entrepreneurs, so they are willing to take risk much easier than VCP, more organized capital. Second is the ability to stay the long term. As a matter of fact, we never ask for exits. That's one of our rule. And the only time we ask for an exit is when the founder is leaving. That's when then he knows it's the best time. And I think the third thing is the ability to stay and not having a clock against you. As a professional fund manager, you have to return your IRRs, right? So and that's when your incentive structure is based on a carry. In our case, it's slightly different. We actually the metric we check is slightly different. It's not a return of capital, but it's either impact or disruption or ability to create large scale businesses or global leaders. So when you have that as your as your motor, as what you want to become, then the way you look at things change significantly. So I think that's the fundamental difference the way we see it. In terms of deal flow, a lot of family office angel investor bets are on an idea, early stage. You look at it today, most of the best investors in India are ones who just take a bet early on with just one meeting, one WhatsApp message. It's very common, by the way. One WhatsApp message. We are a one meeting person. I wouldn't call us as very diligent investors, but we rely on the VCP community to do all the diligence work. So I think there is a lot of benefit. We work very closely with a bunch of funds globally. I think the real value add for a family office is a couple of things, right? We're always with the entrepreneur. We are very strategic in many entrepreneurships and like companies wherein we can add a lot of value. When there's a PE or a VC who leads the round, we like to co-invest. So we're actually become a co-investor of sorts in many companies. And then eventually we stay the long duration. There have been, we have 5 unicorns in our portfolio. All 5, we had exit points, opportunities, but we never took it because our thesis is that, Alibaba took 20 years to mature, right? Tencent took 20 years to mature. So we're looking for those few multi-generational disruptive companies. And even if you back 2 of them, that's enough. Even we know there's going to be a market recession soon, but it's okay. Because end of the day, we want to back market leaders, guys who are really creating impact in this world. So I think that's a little bit on how we think of them. Portfolio companies and young people like me, they connect with me very easily. I mean, it's usually they call me for the most random questions or the most random help. So I think that's the real value add, to be honest. And most of the time, they're personal help and this help and that stuff. So that's the true value we bring as a family office. And obviously PE and VCs have a systematic method of building businesses, scaling them up, giving value to the entrepreneurs and shareholders and the LPs. And so we actually partner with them in their journey significantly.
Keshav, what kind of allocations you have towards alternatives? So I can understand you are focusing a lot on the direct investments, but what about your investment via private equity and venture capital funds and any sort of co-investment rights you're enjoying with them to select the portfolio, or is it all
Sure.
direct now?
So the mandate that I run is all direct. However, the larger family office is starting to look at becoming LPs in funds or spaces where we don't have deal flow access. That is, for example, alternate proteins is a space where we invested through a fund, or Web3 or blockchain, deep tech. You have to be really a market insider to get really good insights into those internet. Generally, in the entire ecosystem, we do direct. We don't prefer to be LPs because you lose control. And also, I mean, to be honest, if you look at the returns that we've been able to give, it's almost 40-50% higher than VC funds.
Oh, great. Sure. Thanks, Keshav, for that. Nimesh, coming back to you. In your view, has the reliance of Indian alternative investment funds on foreign investors reduced to some extent because of emergence of a lot of new Indian family offices as a very significant investor class? At least that has been our experience over past many years. We currently have nearly 140 plus formalized family offices, something what I read in one of the reports or even in one of the previous sessions what was presented. And with nearly 10,000 ultra HNIs emerging, having a net worth in excess of USD 30 million by 2024, do you see a significant capital coming in the Indian alternative investment funds from these large, small, or mid-sized family offices?
So, Tejas, so two ways to look at it. One, of course, the liquidity in the Indian space has increased a lot, right? And the interest in the private markets has increased a lot, as Anshuman was mentioning. There are two ways people are looking at it. One is going into AIFs. I think that is one of the first wave to start off, right? Because when you are writing a check for the first time, you start off there. Second is, I think, a large part of the money is being allocated to early stage and seed stage, right? Because I think once the company starts maturing enough, right, uh, and there is liquidity in the market, the founder will prefer, branded names, right? So the money goes towards the attention of the founders goes towards obvious names that are out there in terms of, you look at foreign funds, then it would come to tier one funds, then it come to tier two funds. But having said that, I think when people are able to contribute, right, just as Keshav was mentioning, it's not only financial, it's also strategic in terms of, you are able to open doors, you are able to work with the founders, guide them. We are seeing that up to around Series B is when a lot of family offices are actually preferred, right? So founders are now going for a mix of funds who come in and a few family offices because they see a lot of benefits and advantages. Because what is happening is the newer generation of families are getting into investment module, right? So they may be continuing the same business, investing in say D2C. A large conglomerate in say textiles would want to have investments in D2C, so they bring in that business sense, that entire scalability, getting into that kind of mode. And that is what the value add those family offices bring for the founders. And the founders at the same time look at the family offices as partners in their journey, right? So there is a good mix. There is a lot of domestic capital. A lot of domestic funds have raised money last year, right? So of course you will see a good mix of domestic and foreign capital coming into it. But I think one last thought here I would just leave that is that it's also the maturity of the investor, right? I think Indian investors are maturing. There are a handful of names on the family office side who we can say really know what they are doing. But if you look at funds coming from outside India, they're at a very different level. Right? They played the game at a very different level. Indian funds are learning from them. Indian funds are also, like, say, for example, as Keshav was mentioning, the Web3 space, blockchain. I think there's a lot to learn from West there. And that is what is something that people are now looking at coming in. So I think it's a good mix and good blend of Indian funds, foreign funds, and of course the family offices, which is participating, which is good for the founders.
Great. Thanks, Nimesh, for those insights. Anshuman, coming to you, I think one interesting question which I have for you is that we have seen a sudden surge in family offices registering their own alternative investment funds. The same question which I was posing to Amit for a variety of reasons which we were discussing in one of the previous questions. Now, do you see such family office alternative investment funds still making allocations to the other private equity and venture capital funds? And we all know that SEBI norms now allow the alternative investment funds to do a mix of other alternative fund investments as well as investments in other portfolio entities for a variety of reasons, because somebody may want to have co-investment rights to get access to larger deals. Due diligences are carried out by the professional managers and they can piggyback on that. So there are a variety of reasons why they may still want to invest through the PEVC funds. So currently the family office allocations to the alternative, at least some of the domestic reports we have seen, is only 20% of their overall allocations. I think there's one fact which I saw in the previous report, I believe, which 256 networks and praxis had presented. But globally, if I were to look at certain reports, the allocations to alternatives of the global family offices is even as high as 46% or 48% on an average. So do you see this number changing in India when I'm talking about 20%? Is the SEBI law going to help? What's your take on that?
Look, as a percentage of the total asset allocation, I think alternate asset allocation at 20% is not a small number.
Okay.
The question that you have is a different directional question, which is basically directly investing into companies or investing through funds. So there are 3 or 4 things, behind why managers should exist. While this is a question better answered by at least the 2 LPs and large families we have represented on this panel, let me take a stab. We think the reason why managers exist, in asset management are 3 or 4. One is that there is an access to a spectrum of deals, and through the journey of and that is simply because asset management, like many other businesses, has very high operating leverage. If you set up a 8-10 member team, you're better off serving a few thousand crores rather than a few hundred crores, and if so on and so forth. And there is probably a cutoff somewhere around, say, I would say $500 million to $1 billion, where professional family offices begin to emerge. But till then, they focus on a type of deals. I mean, talked about specialization. They may be focusing on deals where the founder family has domain knowledge, or they could be focusing on very late stage deals, which could be de-risked but may have lower returns, or they could be focusing on very early stage deals, where entrepreneurs are looking for new types of capital, which may be very high return but also commensurately high risk. The mid stage is actually the real crux of a private equity manager, or has been in the last 2 decades that I have observed the Indian private equity industry. Now there, the value add the manager brings is access, diligence that you mentioned, a point of view, a connect with the ecosystem. This is a 24/7 job, right? And if there are 8 or 10 people, 3 or 4 partners in any AMC doing this, then they, they are adding value to their investors, to their portfolio companies, through that journey. So it is therefore better handled, and we'd all sort of know this. It's better handled when teams achieve a certain minimum minimum economic scale, and that scale is maybe 7, 8, 10 professionals. Now, can 7, 8, 10 professionals fit into a conventional Indian family office? Maybe we are a few years away from that. And family offices also, for reasons of their own wealth creation, want to do some early stage, want to do some mid stage, want to do some late stage. Their family office professionals may be able to serve one of those segments, right? And therefore they may choose managers for the other 2 strategies, or they may pick managers for sector specific strategies. We have done some sector specific strategies. So this, I think, it is not an either or question. I think family offices will have a desire to engage with companies directly, but funds will also offer that. Funds will offer a more visible engagement to companies. Now, the other way to think about this is, what do companies really want? So I have spoken to many companies which are very happy to engage with large families. Anybody would be interested to engage with a large family like the Infosys family or the Reddy family. But there are companies which say, and which have told me, that we want a finite number of people on our cap table for various reasons, because they are really tight about keeping it in a closed group. Now, this is especially true not of new economy companies, where shareholding has become very, very dispersed of late, but some of the companies which have been very successful in the decade of the 90s and 2000s. Especially I've seen that in healthcare, where matters of IP are very, very sensitive. This likelihood is, this sensitivity is likely to be greater. In that case, you need a manager. Now, Amit is running an AIF, and they would be directly picking up companies. So they, but for a family office, which is a bona fide family office of a couple of $100 million, I think managers are offering real value there. So we've actually spoken to a large number of family offices which welcome the role of a manager. Now, how does the manager conduct himself? In terms of giving the entrepreneur connect to the family and vice versa, is pretty much how a manager conducts themselves. It's their sort of business strategy, right? But I think direct investing is not coming at the expense of fund investing, if that was the summary question that I was asked.
No, sure, Anshuman. No, I think the SEBI laws have been conducive, because if this question would have been asked a year back, SEBI was allowing a fund, say an alternative investment fund, only to act as a fund of fund or to make investments in portfolio entities. So what has been conducive is, at least now they are allowing that an alternative fund can invest in other funds, and it can also invest in a basket of portfolio entities. So very clearly, if it's a small family office not having a very large independent team of its own, then it can simply piggyback on the other alternative fund managers and enjoy the co-investment rights and also make investments along with them. So I think this model works really well, again, from the regulatory standpoint. So thanks for the insights there, Anshuman. Keshav, I'll quickly come back to you. One key question which I had is, what in your view has resulted in a sudden rush of capital in the new age businesses in India? Now, do you at times witness sort of a fear of missing out amongst family office investors, or for that purpose with any other category of investors? And at times you have seen it has resulted into sort of, I would say, a rush investing. So what's your take on that?
Tejas is absolute FOMO in tech investing. I mean, if anybody who tells you otherwise, they're wrong. If there wasn't, there wouldn't be any alpha. The markets are not rational by any standard. And you can see the valuations globally in China, in India, don't make much sense either. So, but then I think there are a lot of reasons why there's liquidity. This is an interesting generation or an era where there are a couple of sort of factors leading to that. One is the return profile of internet-based companies are phenomenal. So people have started tasting that. So, a lot of sort of post-debt returns have been arbitraged and been checked at it, saying, okay, what are we getting in these sort of other asset classes? That's one. The second is the emergence of a lot of liquidity. Early 20 years ago, if you asked my grandfather to sell something, he would never do it, because the whole generation was never about selling, was always about building for the country, building something. Nowadays, actually, because the lifespan of companies have become shorter, a lot of liquidity has been coming, and it's also market practice and accepted to take some liquidity for promoters, families, entrepreneurs. So that's leading to a lot of capital which has to be deployed. And then the third thing, which I think is, which nobody will say, but I'll say it, is that more digital is disrupting every business. So because of that, people are realizing that, hey, if my business gets disrupted, what the hell do I do? So people are using capital to kind of de-risk their portfolio and de-risk their core business by investing in different asset classes. So a lot of factors are leading to family offices aggressively investing. This is a long-term game. I think investing is a zero-sum game as well. So with more sort of capital, the return profile is going to go down, because the good quality companies are very few, and the market leaders are very few. So I agree with Anshuman that managers have to be there to kind of ensure that they pick the right companies, but also sophistication and family offices are very important. We manage deal flow access so carefully. That's the only thing, if you ask me, we're very particular about. And there are only very few people or very few vectors in which we see deal flow. And that defines our success output. So I think it's very important how you structure. Incentive structuring is almost the most important thing in family office investing. But yeah, but there is absolute FOMO, if I can summarize.
Very, very interesting insight, Keshav. There is an absolute FOMO, and not only in the private market, we saw it in the public market also, when a lot of unicorns actually went public and there was a mad rush for IPO applications. But what happened later is not a very good sight, but yeah,
Yeah.
can see FOMO there. Amit,
Just
coming
to
to you
that point,
for
before we move to it, sorry for butting it, but I just want to add one point here,
Janimesh.
if you may allow me. So exactly picking up from your point on the FOMO investment and what is happening, we are seeing that there are there's an equal space for direct investment, and as we said, 47% of them said they want to come directly on the cap table, balance go on funds. I think there are three types of investors whom we have seen go on to AIFs, right? One is a new family office which has just been formed. They've got new money that has come in. They want to start investing in this space. So the best way is to go to experts and learn about this game. Second is for diversification, as Keshav mentioned, that he will do direct investments directly, but for say Web3 or blockchain or something, they'll go to a fund because you have experts sitting there. And third is, I think that the new investors that are coming in, and which you rightly touched upon on retail, there are so many other people who are coming in as LPs who have a lot of money. They are in tier 2, tier 3 cities. They also want to participate exactly to what Keshav's point was. They want to be part of the FOMO rally, right? And so you'll have an iron trader from somewhere, you'll have a shopkeeper from somewhere, right? I think those are the guys who are coming in as LPs in a lot of generalist funds, right? And the reason why people come to people like us, like we have more than 1,000 family offices at Ultra HNIs who work with us, is primarily for deal access, right? They say that if I want a set thali from a restaurant with 20 items on the plate, I'll go to a fund, right? But if I want to pick and choose from the 300 items from the a la carte menu, those guys come to us. So there is an equal division. Both will coexist, and both will work together, right? But I think this is the kind of nature of the investor community now you are seeing in India, right? So I just wanted to add that. Sorry, Amit, I butted in, but I just want to add.
No, Nimish, I think that's something which Anshuman definitely will vouch for. The 30 number which he was talking about, the funds IFL has raised, and the kind of euphoria the pre-IPO funds and tech funds and the funds offering co-investments in these 2B IPO companies, they would have seen, like FOMO would have been at its best, and they would have seen the oversubscriptions happening like within no time. So yeah, agree to that point. Amit, coming to you for the last question, being cognizant of the time, because I understand Catamaran has made investments across high growth sectors, investing in both early as well as late stage enterprises alike. Now, one, of course, you have touched upon a point that you have been co-investing along with the large VCs and Ps and maybe leading the rounds by yourself at times. But one critical aspect which I also wanted to know is how you have seen exits happening, because let's talk about that also in last many years. From a family office perspective, how have exits panned out for you?
Sure. And I think one of the questions in the audience was, how is our model different from a VC? So one element which differentiates us is flexibility. So while Keshav mentioned that he doesn't actively look for exits, I think one thesis that we definitely go with is good assets. There should not be any liquidity issues, right? So good companies, there are always options available, and the way we look at exits is to back the next wave of entrepreneurs. Given family offices, we have ability to rotate capital and look for newer opportunities and newer entrepreneurs. So to your specific question, yes, we do look for exit opportunities, but more opportunistically. As a practice, we do keep evaluating both sort of, as I said, secondary markets, liquidity in the primary markets. But ultimately, the goal is to partner with the entrepreneur and build a sustainable business. Because if you build a good business, long-standing business, liquidity will come and options to exits will come. So we work with that mantra, if at all. I think that was one of the questions from the panel as well. How is a family office model different? While the IRR expectation do not change, the flexibility is what we offer. The long-termness of the capital is what we offer, and we always have the 3 C's as we talk about, capital, connects, and customers. That's what we provide to our entrepreneurial partners.
Thank you so much, Amit. I think thanks for making my job easy. I think for picking one of the Q&A questions.
Yeah, I thought given the time, I'll mix the two.
Yeah. No, I think we have paucity of time, and I think we'll just stop here. I think we are about to touch 7. So, all right then, gentlemen, seems real optimistic times ahead for Indian family offices, Indian alternative investment funds, be it PEs and VCs, and as a result for the new age businesses in India. So thank you so much, Amit, Anshuman, Keshav, and Nimesh for keeping it so interesting and for sharing your fabulous views. So I'm sure the attendees would have got some real good insights. We also have finished within our allocated time. We are at 6:59 right now. So I'm assuming IBCA team is happy too. So thank you once again, wishing everybody safe and happy times, and over to IBCA team for the next session.
Thank you. Thank you,
Thanks,
Tejas.
Tejas. Thanks, everyone. Bye-bye.
Bye-bye.